Currency risk is typically a byproduct of a fund investing internationally. Especially in the UK, in recent years, there was a move towards more global investment benchmarks. And as a result of this global investment, more and more currency risk is introduced in the portfolio. When the global benchmark is adopted, it's very important for a fund to make a clear distinction between choosing either a currency hedged or currency unhedged benchmark. What is also important for a fund is to remember that liabilities will remain in sterling, but investments are in different currencies, so currency risk is now part of their portfolio. And it's important to think and plan how to manage this risk. What is also interesting, recently there was a desire to invest in alternative assets. As opposed to equities that are diversified across a number of countries and a number of currencies, alternative assets tend to be concentrated in one particular currency, most notably the US dollar. And therefore, recognizing this risk and planning for how to manage this risk is of particular importance for UK institutional investors, especially today. Quantitative analysis of exchange rates suggests that currency introduces marginal volatility, but not consistent marginal reward for taking on this risk. And therefore, for an investor, it would be rational to remove unrewarded volatility. This volatility can be removed either using a passive strategy or a more active approach. It is also useful to recognize a distinction between developed world currencies and emerging world currencies. Typically, exposure to developed world currencies comes from exposure to overseas equities, and hedging some of that risk is a rational choice that can be justified by quantitative analysis. When we look at emerging market currencies, analysis suggests that consistently emerging market currencies do give investors additional return, and therefore strategic choice is different. In order to benefit from this extra return, part of that risk needs to remain part of the investment portfolio, and therefore reducing risk in developed world currencies and possibly retaining risk in emerging market currencies would be a good solution to consider for an investor. That is a very interesting question to explore how currency risk affects different asset classes. If we look at more volatile asset classes, like for example overseas equities, impact from currency risk is less pronounced. And the impact from risk is less pronounced because the volatility of the asset class is high, but also exposure to different currencies introduces a natural level of diversification. In this case, hedging a smaller proportion of currency risk might be an optimal choice. On the other hand, there are low volatility asset classes, and this might include fixed income investments, alternative investments in property, infrastructure projects, some of the hedge funds. In this case, the amount of currency risk will be relatively higher, and therefore choosing to hedge a higher proportion of that currency risk would be a more optimal approach. What is also important to recognize is how the currency risk and the behavior of currencies correlate with the returns of the asset. And if the returns of the asset in the local currency correlate positively with the behavior of currency, then hedging a higher proportion is a more optimal choice. However, if there is a natural diversification, there is a negative correlation between the returns expressed in the local currency and the foreign currency itself, it reduces the risk automatically, and therefore hedging a lower proportion is a more optimal choice. What is also useful is to try and understand the structure of this relationship between the returns of the asset, the returns of the currency, and try to understand whether this relationship has been observed historically and is more likely to be observed going forward. The most intuitive method is passive currency hedging. When passive currency hedging is implemented, a fixed proportion of currency risk is removed from the portfolio, typically by using forward contracts. The portfolio of passive hedges is rebalanced at regular intervals, and a consistent proportion of currency risk is neutralized. One of the downsides of this simple and intuitive approach is the cash flows from maturing forward contracts. They can be disruptive and they cannot be controlled, and an investor needs to be prepared to find sufficient liquidity, sufficient funds to settle forward contracts that are coming to expiry. Another approach would be active hedging, when the proportion of currency risk that is removed fluctuates over time. There are many ways of currency hedging, but in any of them there is an implicit or even explicit view on the behavior of currency going forward. There are investors who allow managers to take tactical approach and to hedge as the manager sees fit. Very often, investors will choose managers with systematic approach, and systematic approach is more likely to rely on specific patterns of behavior in the currency market. Those patterns can be used as signals to change the amount of currency risk that is removed from the portfolio. Yet another, even more sophisticated approach would be to introduce an element of seeking for additional return. An investor can choose to implement a passive hedge or an active hedge in order to remove part of the risk, either on a static or on a dynamic basis, and then complement this strategy with something that again looks at price patterns but attempts to take advantage of them in order to make additional return. In some asset classes, it is possible to buy hedged share classes. This is by far the simplest approach for an investor. However, not all asset classes can be acquired as a hedged share class. And finally, there is another approach by creating a synthetic exposure to an asset class, and typically it would be an overseas equity. In this case, one or a number of futures contracts are used to create the economic exposure to overseas equities, while cash will be kept in the base currency, in sterling, and a combination of the two, of the futures and the cash, will create an effect of currency hedged portfolio. So there is a passive hedge, there is an active hedge, there is a combination of passive or even active with a return-seeking program. There is an opportunity to buy hedged share classes or to create exposure synthetically where currency risk is minimized. On the one hand, I mentioned a little earlier that introduction of currencies in the portfolio will give unrewarded risk that needs to be managed. On the other hand, in many respects, currency markets resemble other asset markets, and therefore they contain sources of return. And those sources of return will be somewhat similar to what can be found elsewhere, and they can be classified as risk premia or risk factors. Most frequently, investors take into account existence of carry, momentum, value, or growth in emerging market currencies. Carry in currencies is a historical observation that higher interest rate currencies tend to deliver higher overall return. Value is a historical observation that there is a level of equilibrium, and when the prices depart from that equilibrium, at some stage they will revert back to that equilibrium, typically at longer horizons. Momentum is yet another pattern that the behavior of prices is not random in a statistical sense. And information that can be found in the price today could suggest how the price will be evolving tomorrow. Emerging market currencies is yet another observation. They tend to appreciate over time, and typically exposure to emerging market currencies give the benefit of capturing this appreciation as well as higher interest rates that are typically characteristic of an emerging market currency. Taking all this into account allows to create a portfolio that is diversified and balanced and may satisfy the requirement of an investor to create an additional return stream with desired level of risk. We're talking about trading currency for the purpose of reducing risk. So the investor needs to decide which asset classes have currency risk and need to be hedged, what are the currencies that need to be hedged, what are the appropriate hedge ratios or the amount of hedging, and what are the costs. What is the choice of instruments? Typically, investors will choose either to use forward foreign exchange contracts. Sometimes investors may choose to use futures contracts or options. More frequently, it is forward foreign exchange contracts. And in order to trade them, an investor will need to have a trading infrastructure. There are many ways to trade forward contracts, either with banks or with brokers. It is possible to appoint an FX broker that would allow to make execution of FX contracts quicker and more efficient. It is possible to use an online platform with access to multiple brokers to make execution, again, quicker and more efficient. When trading with a panel of banks, investors will need to choose of either trading on uncollateralized or collateralized basis. Some investors will provide collateral by choice, but some may be required to provide margin, initial and variation. And variation margin may be required on a daily basis. And if it is the case, then an amount of cash needs to be put aside. It is also possible to provide margin with non-cash collateral, maybe some of the assets. There are complexities that arise as a result of the necessity to provide variation margin, and it is possible that an investor may wish to consider appointing a margin broker. It is also important to think that for settlement, an amount of cash needs to be available, and a choice needs to be made whether settlement is done on a bank account or at a global custodian. Implementation at first sight may seem complex. However, there is choice of how to implement, and there is an opportunity to find professional advice from either overlay managers or your investment consultants who would be able to guide you through the choice of implementation and trading methods. first side, trading currencies is transactionally efficient. There are no commissions, there is no stamp duty, there are no other costs associated with trading, for example, equities, especially when we talk about using FX forward contracts. However, one needs to understand what are the total costs of implementing a currency hedging strategy. And the total costs, once understood, can be managed in order to find savings and in order to optimize them. One can think about costs as being direct or indirect. Direct costs will include bid-offer spreads or any fees that are paid directly to maintain the infrastructure. It will also be the cost of interest rate differential implied in the forward contract and a more recent phenomenon of FX basis. The indirect costs, this include the amount of cash that needs to be put aside, and therefore cash is not invested elsewhere to earn return, and therefore will dilute the overall return. There are many other possibilities to find indirect costs of allocating sufficient funds to sustain currency hedging over time. And a professional would be able to understand, recognize, and identify all of the costs of managing hedging program and find a way to minimize them and deliver noticeable savings. There is a number of ways currency management can be implemented, and I mentioned some of them. The easiest and the intuitive way is to find hedge share classes. They're available for some investments, but not for others. And there is little flexibility and there is little transparency of costs when choosing to invest in a hedge share class. An investor may choose to appoint bond or equity manager to implement currency hedging as part of bond or equity mandate. However, it's not the core expertise to manage currency for a bond or equity manager. It is possible for some investors to implement currency hedging in-house. It requires infrastructure and investment professionals. For some, it will be acceptable. And yet another way is to consider an appointment of a dedicated overlay manager. In this case, there is the greatest degree of flexibility and transparency that can be delivered to you as a client. A program can be tailored and optimized specifically to your needs. All of you listening are very welcome to get in touch with us via our website. You can call us, you can call me directly, or any member of our client team, and we would be delighted to assist and help you with all your currency needs.